The stock market has yet again endured a poor performance during the month of September, but this shouldn't come unexpected as September is historically the worst performing month for the stock market. However, according to a report by Bank of America, since 1950, anytime the S&P 500 has rallied more than 15% through the month of July, which is exactly what we had here in 2023, during those times we had 15 instances where on average the S&P 500 dropped an average of 8% during the months of August and September. Now, if we look at this chart here, you can see that in 2023 from August 1st through the end of September, the S&P 500 dropped 6.5%. During those 15 instances, we have seen a rebound from the index, averaging a fourth quarter gain of 5%. So are there some tailwinds in our favor for investors? Well, that's exactly what we're going to look at today. We're going to bank on a rally, and we're going to take a look at 5 dividend stocks that we think are going to help lead this rally or partake in this fourth quarter rally. So if you're excited about today's video, do me a huge favor. Click that like button down below, subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Definitely go check that out. Link will be down in the description below. All right, now let's get back to the video, taking a look at 5 dividend-paying stocks that could partake in a fourth quarter rally. All 5 of these stocks are set up quite nicely. So let's begin with the first dividend stock, which is Microsoft Corporation, stock ticker MSFT. This is a stock and a company that makes a ton of sense right now, just given the fact the amount of tailwinds the company has at their back moving forward. Over the past 12 months, shares of Microsoft are up 33%, and they've had an incredible run in 2023 alone. Speaking of those tailwinds, when it comes to Microsoft, the most obvious tailwind is the growth in AI, not only with the investment they have in ChatGPT, but how they're implementing AI into their suite of Microsoft Office products. They have coming out a Microsoft Copilot program, which will add charges to already existing customers if they want to implement this new change for an additional charge of $30 per month. For AI, demand remains high, and Microsoft is finding ways to utilize AI in multiple different products, which will bring in more revenue and drive higher margins. For years, the company's fastest growing segment has been their cloud segment with Azure, but the growth rates have been slowing for a number of quarters now, but still strong growth nonetheless. Another potential tailwind for the company, which is going to be a little bit further out than Q4 of this year, it'll move into 2024, which could be a rebound in the PC market. We have seen very soft PC demand here in 2023, which has not been unexpected. But if that rebounds, that'll be yet another tailwind for the likes of Microsoft. Analysts are calling for 2024 EPS growth of 14%, looking for $10.95 per share, which equates to a forward price-to-earnings multiple of 29.8 times. This is not a cheap stock by most measures, but if we get that fourth quarter rally, like I believe we will, Microsoft will likely be one of those leaders. For comparable purposes, shares of Microsoft have traded at an earnings multiple right around 30 times over the past decade. Analysts are also high on the stock as they have an average 12-month price target of $394 for shares of Microsoft, implying upwards of 20% from today's levels. Dividend stock number 2 on our list is Nvidia Corporation, stock ticker NVDA. Now, I know most of you are probably looking at me saying, Nvidia is not a dividend stock. Well, it does pay a dividend, albeit very small, but it does pay a dividend, so therefore I classify it as a dividend stock. And they have been the pack leader for pretty much all stocks here in 2023. Year to date, shares of Nvidia are up roughly 220%. Yes, you heard that right. It was not a misprint. Up 220% in 2023 alone, even after pulling back 12% during the month of September alone. Nvidia already has the best and strongest chips on the market today. They have so much demand, they can't even keep up with it right now. But on the horizon is yet an even stronger chip that they have coming to production here in 2024. That chip will be called Blackwell, and it is set to debut in 2024. Like I mentioned, it's going to come with an even higher price target for customers, which will increase Nvidia's average selling price and increase margins for the company. A lot of growth is priced in when it comes to Nvidia, but let's take a look and see, okay, is it priced in? Does it look expensive though? Analysts are looking for 2024 EPS of $16.50 next year, which would be 53% EPS growth from 2023 levels. This forward estimate equates to a 2024 earnings multiple of 27.7 times, which actually does not look all that expensive for the kind of growth that we've seen and the kind of growth that we're expecting to see moving forward. 53 analysts cover the stock, and 50 of those analysts have a buy or strong buy rating on the stock. The average 12-month price target for shares of Nvidia is $643 per share, implying 40% upside from current levels. Dividend stock number 3 on our list is American Express, stock ticker AXP. Okay, now we're going to move away from technology, and now you can see we're moving on to financials. And as you know, American Express is a credit card company. The company tends to cater to businesses and high net worth individuals. So if you believe that there will be a pending recession coming maybe in 2024, then American Express customers are the least likely to be impacted from that recession. Over the past year, shares of AXP have lagged the greater market, but are still green on the year, up 5%. However, the company has severely lagged its competitors for the past year, those being Visa and MasterCard. Over the past 12 months, shares of MasterCard and Visa have climbed 35% and 28% respectively, while shares of AXP have climbed only 7%. So you can see just how far AXP has lagged behind those two companies. American Express will continue to have a growth path with high income earners, but they're also trying to implement a strategy to relate to Gen Z and millennial consumers moving forward. After all, you've probably heard by now, we have surpassed here in the US credit card debt of over $1 trillion. And that has actually showed in the American Express financials as the company continues to report strong consumer growth trends. All of this together is one reason that I'm taking a closer look at shares of AXP. But the other reason being, valuation is quite compelling. Before we take a look at valuation, let's take a look here at the dividend. AXP pays a dividend of 1.6%, but they also have dividend growth to their name, having increased their dividend at an average of 10% per year over the past 5 years, including dividend hikes of 15% and 20% respectively each of the past 2 years. In terms of valuation, analysts are looking for EPS of $12.43 per share next year, which equates to an earnings multiple of just 12 times, which is below their 10-year average of 15.3 times. Analysts are also high on the stock as they have a 12-month average price target of $178 per share, implying 19% upside from current levels. Dividend stock number 4 on our list is L3 Harris Technologies, stock ticker LHX. L3 Harris operates out of the aerospace and defense industries, operating as a defense contractor. However, the stock has not been that great for investors. Over the past 12 months, shares of LHX are down 25%. And we'll talk a little bit more why that is just here in a second. The global unrest that we're seeing taking place all over with Russia's invasion of Ukraine, we're seeing the unrest going on in the Middle East, and now we're seeing China taking a closer look at a takeover of Taiwan here, potentially in the near future. All of this has many nations putting their defense spending and defense budgets at the forefront and the highest priority. All of this benefits a company like L3 Harris. The rising demand is not a new story when it comes to L3 Harris. After all, orders were up nearly 20% in the most recent quarter, and the company's backlog is at $25 billion. They have more work than they can handle right now, which is usually the case with aerospace industrials. The issues that L3 Harris has been running into has been high inflation, which I don't see that going away anytime soon, but the other being supply chain issues. That is something that they're continuing to work through, and management is starting to see improvement on. And as they get more improvement, they'll be able to not only work through their backlog a lot faster, but potentially get better pricing moving forward. L3 Harris is a unique defense contractor as they not only provide products within air, land, sea, but they also specialize in cyber and space. Space and cyber are two areas that are expected to continue growing in the near future. Although L3 Harris is more of a lesser known dividend stock for some of you, they are nearly a dividend aristocrat, meaning they have increased their dividend for 21 straight years. To be a dividend aristocrat, you have to surpass 25 consecutive years. L3 Harris has a dividend yield of 2.8% with a 5-year dividend growth rate of 14%, making them firmly a dividend growth stock. I believe there's been a sizable disconnect between the stock and the company because the company results have been quite good. So good that management decided to increase guidance in the latest quarter. But what this does is provides long-term opportunities for investors like myself. Analysts are looking for EPS of $13.29 per share next year, which equates to an earnings multiple of 12.3 times. Over the last 5 years, shares of LHX have traded at an average earnings multiple of 18.3 times. Analysts are also very high on the stock as they have a 12-month price target of $216 per share, implying 32% upside from current levels. Before we move on to the fifth and final stock on our list today, let me tell you about a special promotion over at Webull. Right now, if you open up a new account at Webull and deposit any amount of money, they will give you up to 12 free stocks that could be valued up to over $30,000. Check out the link down in the description below. Dividend stock number 5 on our list is ConocoPhillips, stock ticker COP. ConocoPhillips is a play on the rise in crude prices. ConocoPhillips is not only an explorer of oil and gas, but they're also a producer of oil and gas. And as we have seen towards the end of September, prices of crude topped out around $94, but fell swiftly from there down to $82 a barrel just a week later. During the pullback in crude, shares of COP pulled back 10% over that same period. However, that gave investors that may have missed the first run on crude another shot, as I fully expect elevated oil prices to stick around, making this a unique time to look at oil stocks. After that 10% pullback in the past week, shares of COP are now only up 4% on a year-to-date basis here in 2023. What is driving up the prices in crude, you might ask? Well, for decades, Russia was a large producer of oil and gas, and they have largely been cut off by many countries across the globe. In addition to that, OPEC, another large producer of oil and gas, has slashed their supply, meaning that there's going to be less supply, and if demand remains high, that drives up the price of oil. And now we add on the unrest going on in the Middle East that will only further drive up, in my opinion, the price of oil here in the near term. When I'm looking at a stock like ConocoPhillips, energy isn't typically a long-term play for me. It's very cyclical. So this is something that I'm looking at more as a short-term play. Really just a Q4 ride the wave here towards the end of the year. When the price of crude gets elevated like it is right now and going to continue in the foreseeable future, that only adds to the free cash flow and margins for these oil companies, which allows them to buy back tons of stock and potentially increase their dividend. Remember, when companies are able to buy back stock, that means if you're holding a share of, say, COP, there's now less shares that are out there, making your current share that much more valuable. And after all, companies don't just blindly buy back stock. They typically do it in big chunks when their share price looks quite intriguing. Speaking of that, analysts are looking for 2024 EPS of $10.20 per share, which equates to a forward multiple of only 11.3 times. For comparative purposes, shares have traded at an average multiple of 13.5 times over the past decade. Analysts also have a 12-month average price target of $133 per share on shares of COP, implying 15% upside from current levels. All right, there we just took a look at 5 dividend stocks that could ride the market rally through the end of the year. We took a look at 2 technology companies in Microsoft and Nvidia. We also took a look at a financial company or a credit card company in American Express that has been lagging its competition or its peers. Then we moved on to a defense contractor, which is a little bit unique with its cyber and space exposure. And then lastly, we looked at an oil play. With the rise in oil expected to keep moving forward and plowing even higher, ConocoPhillips is one that can definitely take advantage of higher prices, meaning more cash flow and buy back more shares more dividends. In the comments section down below, let me know which of these 5 stocks do you believe will have the biggest rally into the end of the year. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next video. Take care.